so the buses will leave from outside the faculty block, which all of you know, at 6:30. So the buses will be lined up there, so just be there at 6:30. Okay, so let's start the second plenary session. I'm absolutely honored to introduce Professor Kiyotaki, who is currently a professor of economics at Princeton University. And I'll say at the outset that he's one of the world's leading macroeconomists. He's finished his PhD from Harvard in 1985 and has held academic appointments at Wisconsin, Minnesota, LSE before coming to Princeton in 2006. He's also an academic consultant to the New York Fed and is a fellow of the Econometric Society. He won the Giorgio Janssen Award for his work with John Moore on credit cycles and the 2010 Stephen Ross Prize in Financial Economics. His contribution to macro theory has been fundamental. He's had seminal papers. His work with Olivier Blanchard is a forerunner to the modern NKDSG model. His papers with Randy Wright have revolutionized search theory, and his paper with John Moore on credit cycles has been fundamental in understanding the recent financial crisis as well as the last decade in Japan. And this work has helped to further develop the new literature in macroeconomics with imperfect capital markets. In recent years, he has moved on to looking at emerging market economy issues, but in particular the transmission of external financial shocks, which is going to be the subject of today's talk. And in particular, he's been asking why EMEs are so vulnerable to foreign financial shocks, and whether there is scope for coordinating monetary policy with macro-prudential policy so that monetary policy can focus on its own tasks better. He's also been involved in the new and exciting area on heterogeneous agent, new Keynesian models, what is now called HANK, and he may talk a little bit more about that. I'll end by saying that Thomson Reuters lists Professor Kiyotaki among the citation laureates who are likely to be future winners of the Nobel Prize in Economics. So may I please invite you to the floor. Thank you. Let's give him a round of applause.
Thank you very much for having me here, and I'm very honored to be here. Actually, when I was a graduate student at Harvard in the second year, I bumped into one of my advisors, Olivier Blanchard, and Olivier asked me, what do you want to work on thesis? And I said, I want to introduce financial frictions and banking into macroeconomics. And he said, that's not interesting. That's not important. Moreover, you cannot do it. So that's, and obviously, Olivier is an instinctive man instead of contemplative man, according to Ariel's classification. But probably Olivier was right when I tried to do it as a graduate student to introduce the financial friction and banking into macro in early 80s. Probably I didn't succeed, and I wouldn't be here actually. That's why I switched to the monopolist competition macro for the thesis, actually. But today I go back to that original things, and I'd like to think about the emerging economy issues. And I realized the emerging economy is always very different. So each emerging economy has their own problems. But one of the problems people often argue is actually emerging economy is very vulnerable to the external shocks, especially external financial shocks. Like people call it the sudden stop. Suddenly the foreigners stop lending to you and the emerging market bond premium shoots up. And so the one question is why emerging economy is so vulnerable to the external financial shocks? And also, how should you do the monetary policy in that kind of environment? And do you need to coordinate with the macro-prudential policy? And that's the question I'd like to ask. This is a very theoretical piece, and it's more macro than micro. And but many of you, I observed yesterday working on the microeconomic issue to reduce the poverty. And macroeconomics of emerging economy has a peculiar feature. One thing actually Raghurajan said is you cannot do the two drastic things in emerging economy. Like in US, like in order to fight with inflation, Paul Volcker raised interest rate into nearly 20% in late 79. And it succeeded to suppress the inflation. But if India tried to do the same thing, people die. Like, you cannot do that kind of drastic things because there is no enough social safety net to do that kind of like extreme policies. And in fact, the Volcker's policy create a big mess in Latin American countries, actually. But so you have own problems, and reducing poverty is the first order importance. But at the same time, macro economics policy has their own constraint. And why the emerging economy in general is vulnerable to the financial shocks. And in order to understand, we built a little framework thinking about there is a bankers who can raise fund from the household, as well as the raising fund from the foreigners. You borrow money from foreigners too. And this bank need not be just the usual bank, commercial banks, but any kind of organization who can raise fund from foreigners, like a large corporation who have a foreign office, or they can issue the bond. That's included. So the one characteristic I'm going to focus is that typically the domestic borrowing is in terms of domestic currency, nominal contract, as well as the foreign borrowing is often denominated in foreign currency. So it is, therefore, the banker is facing the exchange rate risk. And the banker is going to use this borrowed money together with the net worth to make the finance to the business. And here, if the financing is, we are going to concentrate in financial friction in the banking sector. Therefore, actually, we are going to ignore the financial friction between these. So most of the focus is the financial friction of the banking. And the alternative way of financing, besides the banking, is the direct financing. The household is going to lend the business directly. Sometimes this goes through the informal credit market, or sometimes it goes through the corporate bond or the equities. But often the banker is better in financing, or they have a particular skills household doesn't have. So certain kind of financing only banker can do. And so this is the situation we are going to think. Before writing down the model, so I will give you the intuition about how the external shock affects the economy. So this is the simple flow chart you can think of. So the shock is coming from foreign cost of funding. This interest rate, foreign interest rate, need not be just Fed raised interest rate like yesterday, but the more like a bigger one is emerging economy bond premium shoots up. Not just the central bank raise interest rate, but the foreign central bank raise interest rate. But the bond market, the people asking higher spread. And so when foreign interest rates go up, typically the foreign exchange rate of the emerging economy depreciate. People switch the portfolio to foreign denominated assets rather than home assets. And so exchange rate depreciation itself is not the bad news for the exporter, because of they become more competitive, they can export more, so which has a positive impact on productions. But actually when exchange rate depreciate, some of the goods are imported, and imported goods become more expensive. Imported goods can be raw materials, intermediate goods, as well as some of the consumers' goods or the investment goods. But it tends to push up the inflation rate. And modern inflation targeting theory says actually when inflation go up by 1%, you have to raise interest rate more than 1-to-1. Otherwise, real interest rate go down, so it will reduce it will fail to control the inflation. So you raise interest rate more than 1-to-1 with the inflation. And that has a bad impact to the bankers. And the cost of funding is going up. Moreover, the dangerous thing is the asset price starts falling. So the banker is lending money, and if the banker is lending money, risky loans, and effectively bankers' repayment depend upon the business performance or the asset value. And asset value starts going down, the banker starts losing the net worth. The assets versus liabilities, the asset value drops, the banker is going to lose the net worth. And debt doesn't decrease with the asset value. If the banker has a non-performing loan, the value of the loan drops, the debt is still sitting there. Therefore, net worth is dropping faster than the asset value. So this is sometimes called the leverage effect. If the banker's asset value drop by 10% and debt is 50%, net worth is dropping like a 20%. And then the bankers' net worth is going down, their ability to finance the capital investment starts going down. And but when capital investment drops, actually who is alternative people, who is lending, is a household. But the household is not as good as banker in financing capital investment. The asset price drops even further. And when asset price drops further, net worth is dropping faster. And microeconomics, typically price drops, demand go up. And macroeconomics, sometimes price drops, net worth is dropping faster than price. As a result, the banker's capacity to lend can go down, which is the demand curve is not the downward sloping, it's actually upward sloping, which happens if the banker has an outstanding debt. This is one of the key aspects of propagation we emphasize in credit cycle. Yeah?
So, can you go back?
Yeah.
So, is there a good reason for why foreign debt cannot be directly
To this
business?
one. Yeah, this is anyone who is doing the business, we call it the banker. So non-financial business who can raise fund from the foreigner directly, we call it banker. And in fact, like a Bank of International Settlement, they are worrying about the non-financial business acting like a banker, raising fund and do the carry trade. So that's in banker too. Yeah, shadow banks. So this propagation is going to reduce the investment. And when initially export go up is a good news, but actually the investment go down is a very bad news. And eventually emerging economy can enter into the recessions because of the net worth is going down. So there are three reasons net worth of the banker can go down. One is the exchange rate depreciation. If the banker is raising fund from foreigners, exchange rate depreciation is a bad news. That burden go up. Moreover, the real interest rate go up, the domestic funding become more expensive too. And the killer is actually the net asset price drops. Asset price drops and non-performing loan expand. That is the big killer of the bankers. And the three things together, net worth of the bank drops substantially and investment drops. And that's why the foreign interest rate go up is a very bad news for the emerging economy. So in order to formulate this kind of idea, let's write it down, the model. And the model is the kind of New Keynesian model with a bank. So the New Keynesian part is basically the output is produced by the bunch of the intermediate goods. And the intermediate goods producer is monopolistically competitive. The reason we use the monopolist competition is if the profit function become very smooth function with price, and therefore there are some reason there is cost of adjusting price. There is a tendency price is going to be sticky. On top of the sticky price, the key aspect is if you face the downward sloping demand curve and some reason aggregate condition improve, you can sell more at going price. The perfect competition, people don't want to sell more because of marginal cost equal marginal. The price, you don't want to sell anymore. You just say go away. But monopolist competition case, the people are happy to accommodate demand. People are always eager to sell at going price. And that's why we are using the monopolist competition for the sticky price and the demand determined system. One characteristic we have is each monopolistic goods, differentiated intermediate goods, is produced from capital stock and imported material, M, and the labor. We put the import into the intermediate goods. So that's the M. Share of the imported material is alpha M. And as a result, the marginal cost is a function of real wage and the rental price of capital, and also real exchange rate. So epsilon is the real exchange rate, relative price of foreign goods relative to the home final goods. And each monopolist is setting price as well as the output to maximize expected discounted utility of profit. Profit is sales minus the cost. This is constant return, so that's the profit. And there is a little cost of adjusting price. Changing price from last period is a costly. This is Rothenberg way of doing, and it turns out to be very easy to do this. And actually, after solving, this is the marginal rate of substitution of consumption between date 0 and date t, stochastic discount factor. But if you solve the first order conditions, you can get something called the forward-looking Phillips curve, which is today's inflation rate. Pi is the inflation, the 1 plus inflation. Is inflation rate depend upon tomorrow's expected inflation rate as well as today's marginal cost. So forward-looking aspect is the difference from the traditional the Phillips curve. And so that's the New Keynesian part. And the output is produced from the investment, and the investment is subject to the adjustment cost of productions. If you produce different amount from the steady state, I, you have to pay the extra cost. Without this increasing marginal cost aspect, price of capital is going to be constant, like a standard RBC without adjustment cost. Actually, capital and final goods are the same goods, and the price is always 1. Here, we have a adjustment cost. The price, capital price can move around. And the export, we just expose it, which is the export is a decreasing function of relative price of home goods relative to the foreign goods. E is the nominal exchange rate, and this is the foreign nominal price. And we assume the foreign country doesn't have inflation. Therefore, this gap is the real exchange rate, relative price of. This is maybe the other way around. Yeah, I'm sorry, I have to go switch around. Sorry, go this way. Yeah, the foreign goods price relative to home goods is the real exchange rate. Okay, and household, how to think about it, household consists with continuum workers as well as bankers. And each banker is going to manage the one bank. This is a slightly funny model, but we try to keep the representative household assumptions. So therefore, the household consists with a lot of people. And some people are working as a worker. Some people are managing the banker. And at the end of the day, they consume together. This is like a big Indian happy family model. But each banker is going to manage the bank until retire. And when they retire, they bring the money back to home. Until then, they just accumulate the net worth. And the reason we did this kind of funny retirement model is often if you have a financing constraint, there is an incentive to save away from the financing constraint. Like keep accumulating net worth so that at the end, they don't need to borrow money. And so in order to limit that internal saving or the dividend payout, we have this simple exogenous retirement model to motivate the payment. And then when some worker, some banker retires, and there is a new banker coming in, a new worker becomes new banker. It's a bit like a professor retire and the graduate student become a new assistant professor, and the life continues. So that's the model actually. And the household can also lend money directly, but they are not as good as banker. So therefore the household can save in the bank, or at the same time they can lend money to others. But when they lend money to the business, it costs the management cost. This is the disadvantage of the household against the bankers. This financing is costly, and while the banker has a skill to finance well. So, and that's the model. And the household is maximizing discounted expected utility of consumption. And the utility, we use something called the Greenwood-Hoffman-Herkovitz style model, which is this utility of labor is subtracted from the consumption, which turns out to be very useful to get the analytical solution, as well as the labor supply become pro-cyclical instead of counter-cyclical. And maybe India, it may not be so bad idea. Like this says in order to work, you have to eat first. And if you don't consume, you don't have strong enough energy to work. So that's the utility function we have. And the budget constraint is consumption and the purchase of capital, direct financing. But direct financing requires extra management cost, this guy. And the deposit is financed by wage income and the profit. And the profit comes from monopolistic profit, as well as the little bit of profit of doing the banking business. And this is the return of loans. And every loans, we are going to use like an equity contract instead of the debt contract. It's almost like we are ignoring the financial friction between the banks and business, means the banker is owning the business, basically. Or the business can pre-commit to pay all the gross profit, the capital returns, to the bankers. Therefore, effectively, we are ignoring the financial frictions, completely ignoring financial friction between banks and the business. And the household can do the same thing, but require extra management cost. All the friction is between banker and the lenders. When you add some frictions, you have to subtract other frictions. Otherwise, becomes economy. The model becomes too many frictions, and you don't know what's going on. So that's what we do. And when you solve the first order condition, you get the usual labor supply conditions and the saving conditions for the deposit. On top of that, you get the marginal condition of equity holding. Equity holding, we use the quadratic functions, and therefore, in order to buy the equity, not only pay the cost, but also you have to pay the management cost, marginal management cost. That's creating the wedge. So banker doesn't need this, but the household need that. That will generate a wedge between the return on owning capital between banker and the household. What about bank? The banker is financing the capital investment by issuing the home currency denominated deposit. The key is the deposit is the non-contingent contract and denominated in terms of money. I'm not going to justify this. Actually, if you are theory-oriented, you want to explain why this contract is the optimum contract. But we are not going down deep as much as the mechanism design in this sense. So our theory is kind of applied theory. And again, the lending to borrowing from foreigners insist to lend in terms of foreign currency, which is the usual practice. But again, why don't you hedge and all these things? Question will be coming out later. So this is the assumption we are going to impose now. So home borrowing deposit is denominated in home currency. Foreign borrowing is denominated in foreign currency. And as I said, there is no financial friction between bank and non-financial business. Bank finance capital investment by issuing buying the capital ownership or equity. So all the financing is through the securities or the partial ownership. And the banker is maximizing expected discounted utility of dividend. And the dividend is paid only if the banker retires. This is the banker retires at day t plus j. And the day t plus j minus 1, they continue to operate. The banker's retirement is until retire with probability 1 minus sigma, sorry. So probability of retirement is 1 minus sigma. Probability of continuing is the sigma. So this is the probability you retire for the first time at day t plus j. And I'm not going to go to yeah, okay, so that's the banker. What is the macro-prudential policy, I said? The macro-prudential policy is often about the capital requirement. So capital requirement says in order to hold the risky loans, you have to hold the bank equities. But that is implicitly taxing the banker's risky assets holding and subsidizing the net worth. The other policy is restrict the foreign currency borrowing. Foreign currency borrowing is dangerous. They try to restrict. And the way we think about it is it's a tax on foreign borrowing. And this is the balanced budget conditions. If bankers, this is the tax revenue from risky assets holding. This is the tax revenue from the foreign currency borrowing. And this is a subsidy to net worth. If this is a balanced budget, you don't see any movement on money. But it's like a flexible version of the capital requirement or discouragement of foreign currency borrowing. And what's the flow fund of the bankers? Banker is buying equity, paying the tax, and partly financed by the net worth, partly financed by the deposit, partly financed by the foreign currency borrowing. Foreign currency borrowing, you multiply the real exchange rate, and some fraction you have to pay the tax. At the end of the day, this is going to net out, but the incentive-wise, individually, you can deviate from the average bankers. So that enters like a budget constraint. And this is the net worth of